Okay, good afternoon, everyone. So I'm presenting today on behalf of Dr. Szu-Hsien. Uh, this research was conducted at the Department of Accounting and Information Systems, Asia University, Taiwan. Okay, so let me give you the big picture first. This study looks at Taiwan's list electric wire and cable firms and asks a simple question. Instead of treating EPS as just a continuous numbers, what if we look at which earns interval a firm falls into: loss, break-even, or different profit tiers? So we use a multinomial logic model with small profit as the reference category based on quarterly data from 2015 to 2024. The key finding: firm size and profitability measured by ROA are the strongest predictors, while leverage turns out not to matter much. Okay, so now why does this matter? Most prior studies treat EPS as a continuous variable, but that's not really how investors think. They care about whether a firm is losing money, breaking even, or profitable, and how profitable at the point. So wire and cable industry is also a great setting for this, since it's capital intensive and earnings performance varies a lot across firm. So our objective are threefold: convert continuous EPS into multiple earnings intervals, examine how firms' characteristics, size, leverage, ROA, ROI, and market to book affect that classification and use a single industry design to eliminate across industry noise. So here's how we set it up. We use quarterly data from Taiwan listed wire and cable firms from 2015 to 2024, sourced from the TEJ database with year fixed effect included. The dependent variable is EPS, classified into four categories: loss, small profit. So our reference group: moderate profit and high profit. As for the independent variable size, the point is size. Size is the log of total assets. And LEV, the second one, is the leverage ratio. ROA, the third one. ROA is return on assets. And ROI, this one is return on investment. And MW is the market to book ratio. So we run a multinomial logic model to estimate the probability of each interval relative to the small profit baseline. Now, let's look at the numbers across the sample. Means EPS is 0.782 with a median of 0.5. So the distribution is a bit right skewed. EPS range from as low as negative 2.49 to as high as 8.54. So we do have both loss-making and highly profitable firms into the same in the sample. Sorry. So for firm characteristic, mean size is 16.03 and mean leverage is about 36.35%, which reflect how capital intensive this industry is. So mean ROA is 2.66%, modest, but again, with real variation across firms, real variation across firms. Okay, so result 1 here. So here are the core results. Starting with firm size. Size shows positive coefficient in both the moderate and high profit intervals. In plain terms, larger firms are significantly more likely to land in the higher profit categories. This supports the economic of scale idea. So now, ROA turns out to be one of the 2 key predictors in the model. Alongside firm size, positive in the high profit interval. Here, positive in the high profit interval and negative in the loss interval. It's one of the most statistically significant variables we find here. And confirming profitabilities is a key. That's the point. It's driver of which earns tier a firm ends up in. Okay, so result 2 here. So what about the other variables? Leverage doesn't show a systematic pattern. Debt structure just doesn't predict earning intervals in this industry. So ROI here is significant in some intervals, but it's unstable. The effect shifts depending on the model and the time period. Market to book is similar here. Significant in some intervals, but the coefficients aren't consistent. So its influence looks context dependent rather than reliable. And the year fixed effect shows that certain years had a positive effect on landing in the high profit interval, which likely reflect broader microeconomic and industry cycles. So what does this mean? Size and ROA are clearly the dominant factor here, reflecting two underlying mechanisms. Larger firms benefit from economic of scale, more operational efficiency, less earnings volatility, and a higher chance of landing in a high profit tier, right? Firms with higher ROA are simply deploying their resources better, which makes them more likely to be classified as moderate or high profit. Leverage not mattering here tells us something too. It suggests debt structures affect earnings is industry specific, not universal overall. So overall, this interval-based approach captures threshold that matter to investors, loss, break-even, profit, in a way continuous EPS model just don't. So to wrap up, earning intervals give us a more behaviorally realistic lens than continuous EPS, right? Size and ROA are the primary explanatory factors, and our single industry design strengthens the internal validity of that finding. Leverage, ROA, and market to book all shows limited or unstable effect by comparison. Of course, they are limited. They are limited. We are restricted to the wire and cable industry. So generalizable ability is limited. And we don't account for corporate governance, competition, or macroeconomic variables. For future research, this could extend to cross-industry comparisons, dynamic panel models, and adding governance of microeconomic moderators. That's the point. Okay, thank you, everyone.